Welcome to Real Estate Investing for Professional Men and Women, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hello, this is Gary Wilson, and welcome to this week's Real Estate Investing for Professional Men and Women, the podcast for you and me, typically professionals, often business owners. And the way we invest is we do it the right way. I'm not knocking all the other ways. I'm just telling you, we don't do the no money down stuff. I mean, you can do that, and I've done it before. It has its place. It's just not every place. The fact is if you're a business owner, you understand the principle, profit, loss, income, expense, asset, liabilities, financial statements, and you got to be in a solid position to grow and not just survive, but thrive, okay? So in any case, if you haven't already subscribed, please go ahead and do so on all kinds of different channels, Stitcher, iHeart, iTunes, iHeartRadio, downloaded in 30 some odd countries. And also, if you do want to be part of the community, all right, it's just open. Just go to myinvestorservices.com, click on members area, and you can see how you can, if you're already a member, log in on the left. On the right, if you're not, you can check it out for free. I suggest you do that because there's thousands of us out here now, literally over 4,000. And I've trained 24,000 people in classrooms to do this stuff. And again, I'm not against any other type of investing. I just know that if I can get you on a cash basis, it's not that you don't get creative. It just puts you in control. Then you can get creative after you control the asset. So we do joint ventures together. We get access to capital and things like that. But today is a unique subject. It's all about tax planning and using the tax structure effectively because it's there for us to use with Dusty Rollins. So Dusty, welcome aboard, man. I appreciate you taking your precious, valuable time to share your knowledge with our followers here,
Thank you, Gary. I'm very happy to be here and excited about this morning, the talk here.
Excellent. Hey, if you wouldn't mind, for those who don't know you, would you mind just painting a picture first? Just give us a picture of who's Dusty Rollins, and even if it's got some humorous stuff in there, your background, and then we'll get into what you do, and then we'll go with maybe some case studies to show people like dentists, business owners, what they can do and how they can do it.
Happy to, Gary. So. With all that pressure now to be a comedian, I don't know if I can be funny, but so I grew up, I had a little bit of an interesting childhood. I grew up in a boarding school in Asia, and so that gave me a lot of a unique perspective. So I've lived for long periods of time in Asia, in Europe, and then obviously in the U.S. I live in Florida now, and that just gave me a very a broader perspective on things. And so when I came back to the States and went to college. Pretty quickly, I graduated from college, and then I pretty quickly realized I was unemployable. So, the dentist route, the doctor route, I faint if I see see my blood, particularly my own. I knew that the traditional professional services route, lawyer, attorney, all those things weren't in the cards for me. I hated school, but I love learning, if you know what I mean. So, yeah. I was kind of a reluctant entrepreneur. I think there's a book out there. I kind of fell into it. I didn't have this grand plan from 6 years old. And so I started in real estate. Actually, after your introduction, I hate to mention this, but my very first start was Carlton Sheets course off of TV. Remember that guy?
Yep.
Yeah. And so, this was way back, but I started into, a little bit of residential real estate there. This was back in the, went through the boom when any idiot could make money. You buy it. And then if it takes 3 or 4 months to fix it up, and then you get 5 full price, above list offers. So I did, I kind of cut my teeth in that. And then I got into business. And as I was in the business world, I began to realize, the first few years I didn't have a tax problem because I didn't make any money. Mm-hmm. Then one year that first year when I started to make a little bit, I had a CPA at the time, and I was like, this can't be, he said, well, here's what you owe. And I'm like, no. You mixed my file up or try again, go back and, I reject this offer, go try again. So that kind of led a self-study of, I knew that the tax code, it's 77,000 pages of laws and rules and case studies and court cases. And I knew in there was a kind of a path to freedom. and to really minimizing the tax bite. And then what I tell people too is, our country was really formed off of tax rebellions, right? The Boston Tea Party is the famous one. But we have a history of that because we understand that taxation is and don't worry, I'm not going to go on a rant, but taxation is a form. If you can't get your taxes right and you're overpaying continually, you're losing some liberties there. So that was a philosophical reason. So I began to plow in, kind of learning taxes on my own. And then about 8 years ago, I decided to kind of move this as a profession. So I do tax planning almost exclusively for business owners or a professional who has a side business or real estate. And I was telling you, Gary, at the beginning, I like to say, if you don't have a business, the IRS punishes you if you don't have a business. Yeah. So if you're just, all you have is a W-2 income, you get there's 3 deductions, and the Trump tax plan actually took some of those away. You have almost no planning. It's like you just pay. If you have a business, if you have real estate on the side, then that opens a portal to a whole bunch of tax planning options. So that's why the business owner angle is so important. And so then that just led, and I think I'm a little bit of a unique gap I'm hopefully filling, where I'm not a CPA. I'm an enrolled agent. That means I can work with the IRS. I can even represent, before the IRS. But I'm not an accountant. I'm not the bookkeeper. I'm not the, I'm the big picture guy. I'm the strategy guy. So what's interesting, Gary, a lot of times I'll do a tax plan for somebody, and I'll say, okay, you pay me a flat fee, and here's your plan, right? It's a written plan with guaranteed savings, and then you'll say, okay, Dusty, this sounds good, but I want to run it by my CPA. I say, great. We hop on the call, and you'll say, can we do this? The CPA will go right down the list to go, yep. And then at the end, you kind of want to ask, well, why weren't we already doing this? If we can do it and it's in the code, and it's a strategic thinking difference, if that makes sense. One way I might relate it is a lot of your investors and yourselves, and I know a lot of you are realtors also, but a lot of the times, I remember when I was doing heavy real estate, I had an agent, and that's all he did, and he was good at that. And he made I don't know, $120 a year just selling houses. That's all he did, and I was making some of that on one deal that he was finding. I would fix it, and he would sell it. Back in the go-go days, but he just couldn't see that gap. Or over that gap, if that makes sense, and nothing wrong with that. So that's, hopefully I'm winding down here. So that's kind of how I got into it, and then how I think I'm a little bit different is that tax strategy part, which is different than just being an accountant.
Yeah, no, I appreciate that. I did notice early on in my business. I was in the corporate world for years. I worked in corporate banking, worked on mergers and acquisitions. Yeah,
big time. Yeah,
but I didn't get any glory. You never saw me on TV. I was behind the scenes.
Right.
I was
waiting in airports, right? Living in airports.
they gave me fancy title to make me feel good, but I wasn't making hundreds of thousands a year. I was reported directly to the executives. But in any case, so long story short is I started investing, and I realized, my gosh, I've got to set these properties up in LLCs, and all of a sudden I go, wow, guess what? These LLCs give me certain tax advantages. So thankfully I came across a tax accountant who also invested, and he was more of a strategist like you are. And he's getting ready to retire. So don't be surprised if I call you here. He's up there, man. He's getting up there.
Sure.
But that's what I realized, my gosh, the tax code is written for us to use, and it's a guide for us to use. And most people don't even scratch the surface as far as what's possible for them. So let's do do you have a case study, like a dentist, somebody that owns your own HVAC business, whatever, so even a teacher that may be flipping on the side, and something like that could kind of give us a case study, if you will.
Absolutely. And if I could say this real quick, Gary, because what you brought up, I think, was so important. One of the huge mistakes I see, like you said, I like to say the government uses the tax code to drive behavior. So remember back in 2009 after the crash, they called it cash for clunkers, caulking for cash. They were just trying to drive behavior and send money back out. But one of the good news and pertinent to this call or to this audience is the government wants you investing in real estate. Mm-hmm. And they will reward you for that. But here's a giant mistake I see, unlike what you were very fortunate there or smart, one of the two, or both. But a lot of people I see, they'll just use, like if they're a dentist and they have a CPA who's running their dental practice, when they get into real estate investing on the side heavily, that might not be the same advisor. You might need to supplement or replace, because if that CPA, if they have 400 clients and 3 or 4 are heavy real estate investors, they're not going to spend the time to learn and master, deep down into cost segregation and professional, real estate status and all those things. So that's a huge mistake I see, is not having a decent CPA that might be able to handle the one business, but doesn't have that expertise in tax planning. So to answer, or into real estate tax planning. So to answer your question about a case study, we like to say I like to say there's 3 levels of taxpayers. It's not official level. I kind of made this up. Mm-hmm. So level 1 is your W-2. You just have, like we said, almost no options. And the only option really in my mind is to go start a business. And that can open it. Then level 2 is that business owner. And that's where you get the deductions like your mileage and all the standard stuff that we know about. And generally speaking, most CPAs, accountants are decent there. Mm-hmm. But I like to tell people there's that 3rd level, that elite level, where you actually begin to partner. And all my libertarian friends it's going to shiver their spines right here. You partner with the government. Now, it's a partnership where you sleep with one eye open, right? You don't trust them. And it's not a formal partnership. Well, here's what I mean is, when what you're trying to do to build wealth lines up with what the government wants you to do, let's maximize that. So again, when you get on those heavy levels, I used to live in Atlanta, and I wasn't in on these deals, but I knew a guy I knew, he would invest in these $30 million mixed use developments. They had retail on the bottom and some low income housing, and then normal retail apartments. And they would get tax credits on that. And then there's a whole market of tax credits, a whole marketplace of tax credits. So if they didn't need all of them, they could sell them, for a slight discount. So that you follow me? So all of a sudden, this deal that would not be that attractive was now attractive because of the tax benefits and because they knew those tax benefits. Right. So that's that 3rd level where you're partnering with the government if what they're doing lines up with what you're wanting to do. Yeah. And here's what I mean also. So for a lot of your listeners, and you need to be starting to pay over $100,000 a year, let's say, in taxes. Mm-hmm. But then you can start looking at things like ESOPs, where if they're structured properly, a lot of times people think only big companies. Here in Florida, Publix is our kind of our famous ESOP. They're completely employee owned. But an ESOP is a way for the business owner to get pre-tax dollar capital to expand business, to grow things, and save in their taxes as well. And that's what I'm talking about. So all of a sudden now you're able to partner with what the IRS, with what you were wanting to do anyway.
If you're anything like me, listening to good advice is helpful and inspiring at the same time. But having a reference guide at your fingertips is invaluable when I sit down to do serious planning. That's why if you go to the website, myinvestorservices.com, at the very top of the page, actually sort of near the middle, you'll see 5 different guides on 5 different aspects of real estate. All these are free, and all of them can help you impact your bottom line. Just check it out. Go to myinvestorservices.com, right smack in the middle, click on any one you want, or all 5 if you want.
So now your case study. So we have a doctor client We've worked with him about 7 years now. And when we started out, he was, and this will be appropriate to your dentist too. You said you have a fair number of dentists on the call. So he was just a family medicine, general medicine, family practice guy. And that's in the medical space, that's a very hard business to stay afloat now. And so we did more than just tax. So we started out with the tax planning, and we were able to cut his bill by $120,000 a year in taxes, which that enables him, that starts to give him money back to expand, to grow, to build his wealth. And so we were saying, we built a pretty smoking retirement plan just off the $120,000 a year tax savings. So I like to tell him off the record, the IRS is building your retirement fund. So, but as part of that too, you're mentioning profit. We were saying, so we helped him expand into research. We helped him expand into a physician-owned lab. We helped him expand into an urgent care. And so again, with a lot of your dentists looking at those ancillary profit centers, and he's not heavy into real estate other than his own facilities. He owns those. So he's not out actively investing. But a lot of dentists, if they can't have these other ancillary, then that's where investing in real estate can be wonderful. And that's where also you're really aligning with what the government is wanting you to do. And again, that's why I started off. This country was built on tax revolts. I'm not here to defend the government. I'm saying smart business owners that I work with, that I see, we line up with what they're wanting us to do anyway. Why fight it? They're giving giant tax breaks. I mean, there are ways you can set up a company and sell it without paying taxes. I mean, it's all out there. You just have to know how to go get it. The IRS hands you the 77,000-page document, says, Gary, this is absurd. They say, here, Gary, here it is. You figure out how much you owe us. Right. And then if we think you're wrong, we're going to squawk about it. And then also, a side note, buried in all of that are all the strategies. I don't call them loopholes because I think loopholes imply, I'm like, it's the tax code. It's either legal or not. Right. It's not a loophole. And it's a matter of, are you going to take advantage of it or not, or discover it or not? Did that kind of make sense?
Yeah, I appreciate that. So let's say, this is an interesting example. I was out in California early in 2019 for the first 6 months, all over the entire state, south to north, teaching. And so I'm teaching, and I was talking to a dentist one time. I actually went to one of their local dental association dinners, and I knew that dentists in most states were eligible for an initial, like a business line of credit. They would automatically qualify by virtue of the fact that they got their degree and they passed their exam and their license. So in California, that's actually $1 million line of credit. I'm like, wow,
I didn't know that.
That's amazing.
Wow.
Yeah. So I'm starting to think, well, boy, what can we do with this? So now obviously that has to be used for business purposes, but if you structure real estate ownership correctly, technically it's a business entity. You own it in any business structure. Yeah.
Absolutely.
So they've already got their practice. In most cases, it's set up as an S corp, right? That's most dentists I know use S corps.
Sure.
And I do too. It's great for any service type business. So let's take one of those. Like, we got the example of the doctor, and that was awesome. But what about somebody who's pretty new, like this guy in California, just passed the exam, he's got his license, he's got $1 million line of credit, and he wants to start a practice? What would you maybe recommend as far as structure that gives him or her the maximum use of the tax code? And if we could even include some real estate in that, that'd be awesome. Like, I know, for example, one of the things I teach my dentists is you can borrow against your dental practice to acquire income producing assets as long as it's in a business structure. You can actually lend money from one entity to the other.
Right.
And that entity pays back the first entity. That interest, of course, is a taxable gain. And you can use the two leverage against each other over time to build your practice and build your holdings. So I'm just kind of painting a big picture. This is what I want my students to do. But in the beginning, like, what do you tell the brand new graduates? Like, they're green. I don't even know what the first question asks,
Right. That's a great question. And I didn't know about that $1 million. That's sweet. I don't know.
Only in California, as far as I know. Yeah,
exactly. So you would, so they're going to, their 60% tax rate is going to grind that out. Anyway, so I would, I'd want to see the terms on the $1 million, and then I'd want to look at that client, because probably that dentist, has 200 or 300 grand in student loans, and and then also if they had enough capital, because what I like about that is most dentists, fresh out of school, they've got the student loan and they haven't built any capital, so it's hard for them to actually open a dental practice. So I would think, in my mind, that would be step one. Take the $1 million, buy a little office, buy the equipment, then now you're renting from your own. But I did like what you were saying, Gary, and again, I'm not an attorney, but in my opinion, the IRS doesn't mind multiple structures. One of the doctors, I work closely with him in another matter, not on his tax side, but he has 55 entities. He's worth probably $25 million. They're okay with all of that as long as it's all tracked, right? Yeah. So if you've got 14 entities and there's money flowing through all of that, that's okay. But it's like musical chairs. When the music stops, it's got to flow, and somebody's got to account for that on a tax side, and then they're okay. They're not okay if it's moving, and then gone, and then they want to know where. So, and I think that is for again, not being an attorney, but for asset protection, that's really, I think, an important thing to have things spread out. And then on a tax point, let me mention these two important things before I forget. With the new Trump tax cuts which went in effect in 2018, people, I think a lot of political on one political side, they were saying it's a tax cut for the rich, and I kept saying it's not a tax cut for the rich, but it is a tax cut for business owners. Right. So one of the keys, though, is the 199A. So it's called QBI, Qualified Business Income. If you've got dentists, and because they're going to have issues, and I'm still seeing issues, even though we're into year 2 of it, because they have a specialized services income where you get disallowed a lot of it. So you need a good accountant who can show that dentist how to have some of that income, and it's a 20% straight up deduction. So on $500,000, if it's disallowed because it's special services, that's a big loss of deduction. And real estate income can help with that if it's set up properly. But then also with the real estate income, you've got to make sure you set it up right. You do your 1099s and you're running it. It's similar to a business so that you can get that 199A deduction. Because as you know, Gary, one of the beauties of real estate is you can actually show a loss on paper while you have a positive cash flowing property, right? That's the beauty. That's kind of the magic of through depreciation and different things. You can show tax loss for profit wise, but you're actually putting money in your bank account. Yeah. But they've got to watch that 199A. They got to make sure. So as they start this year to talk to their accountant, they need to make sure that accountant is addressing that on both sides. And if they just say, oh, well, your specialized income, like for instance, a doctor, when they see a patient, that is specialized income, right? That's specialized services, because they can't see that patient without being an MD in that case. But they do other things, labs and other things that they can make income from that aren't part of that. And so if the accountant's not watching it and just lumps it all in, then you'd lose the deduction on all of it when you could clearly have it on part. Did that make any sense?
It does. Yeah, I know there's the changes came out, there was, of course, if you watch the one type of news and they're saying, well, these people got cut out of this deal, nobody's winning, and only the top people. Yeah. When the other group's saying no, it's actually not true. The lower and middle income people got a lot more breaks on their taxes, and like you said, business owners too. But here's the thing. Here's what I was going to ask you, because by the way, you mentioning that was actually my next question. So I appreciate you.
Good.
But as far as timing, and some of it is going to be sort of depends on what administration's in at the time. But I mean, timing as far as the economic timing, 10 years ago at this time, we were at the bottom of one of the worst economies in the history of the country. And now we're at the top of one of the best economies in the history of the country. Does timing play a role, or has it ever historically played a role in people's tax planning? I don't know if I'm making sense, but like 10 years ago, I might have been doing things differently than I'm doing right now. In fact, I probably was. But how does that come into play? I know the code obviously is, you got to use the code the way the code is at the time that it's written, or
sure,
I'm using it. But have you noticed anything strategic relative to where we are in an economy that people are doing, or maybe should be doing?
great question. So I would see one area that it directly applies. And back to the Trump tax cuts, every quarter I read the Treasury has record collections. I don't think they've ever slipped hardly. They're so even with the tax cuts, the revenue keeps going up.
Right.
And those laws are already designed to sunset in 10 years. So we've already been through 2. So in 8 years they go away unless they're I don't know how that works, but re-verified or whatever.
Okay.
So even there, now we're in an 8-year strategy. But I think to answer your biggest question, one of the biggest mistakes I see people make, like you'll have that young dentist we talked about, they come out of school and some financial advisor will tell them, we'll open a 401k and max fund the 401k because you get a tax savings.
Yeah.
And they'll even use the word tax deduction. And then some smart advisor will come through and say, okay, well, you can set up a SEP or something else and start to get 50 and 60 grand a year in there.
Right.
But again, what I like to tell them is it's deferred, right? Mm-hmm. It's a deferral.
Right.
And right now we are in historically low tax rates, believe it or not, historically low tax rates. So you're deferring now to an unknown time. You're deferring when you're not making that much money. Because I always ask them, if you're 35 now, are you planning to make more or less at 65? Right. They're like, oh, I want to be fabulously wealthy at 65. Okay, well then you may defer. You may defer at a 12% bracket and pay at 60% when you pull it out. Because right. it defers and then you pay on it when it comes out. And we don't know what that rate's going to be. But right. I have never, every time I've asked somebody, do you think in 30 years from now our tax rate's going to be higher or lower? I have never had somebody tell me lower. So, right. But you're on that strategy, you're basing that either the tax rate's going to be lower or you're going to be broke when you go to pull it out. So does that kind of make sense? I like to say, hey, let's pay tax on it. Believe it or not, let's pay the least amount legally, but let's get it out of the tax system. Let's handle that now. Let's not defer it and kick it down. Let's pull it out. That way, if somebody gets in and they do get Medicare for All passed and their $42 trillion budget, they have to raise taxes, right? I mean, right. So if generally the way the governments work is when they make a change, like Roth IRAs, I tell everyone open one because I think at some point they're going to shut them down. But what they do is, I want to be careful in this, I don't want to be misquoted. They almost always, every program I've ever seen, they grandfathered in. So they'll say, okay, Gary, you have a Roth, that's fine, and it works the same way, but Gary's son or Gary's grandchildren, they can't open a Roth. No more new Roths, but you can keep it. I'm not saying they're going to can confiscate Roths. I'm saying I could see a day pretty quickly where they stop allowing you to set new ones up. So if you've got one, and remember Mitt Romney when he ran. Yeah. This is my last little tidbit, and then any questions you have. At one point I think he had, and they were saying it derisively. I was thinking, wow, what a brilliance! I think he had like $12 or $15 million in a Roth IRA. Yeah. Okay. Now, up till that point, I mean, even now, I forget the exact amount, but I mean, up to that point, he could only put in like $5 grand for him and $5 grand a year for his wife. So how in any universe do you get from 10 grand a year to 15 million? Well, I don't know exactly his inner workings, but it was some form of putting options down, probably on real estate. Real estate has options, yes. Mm-hmm. So if the money's in the Roth and you put options down on a property and you sell that option, or you make money without actually even possessing the property, then that money can flow back to, again, I've got to couch all this because each situation is different. I'm just saying that's how all of a sudden you can take small amounts of money and put giant amounts back or get giant amounts back in. So that would be another reason for that tax planning, right? Because some of your investors could do that, start small. They might discount saying, I can only get 12 or whatever it is now, 14 grand a year if I'm married into a Roth. I can't do much with that. But you can actually build that up. And then if you had $12 million in a Roth, you're going to be okay. Because that comes out tax-free. Yeah. I'm done. That's it. Any questions or?
Yeah. Well, actually, that was perfect because that was exactly where I wanted to kind of wrap things up with was that whole subject.
Perfect.
So let's do this. I got a feeling you just really piqued interest of a lot of people. So if you could, is there anything you have like a book you've written, an article you've written, a podcast you have, anything people can kind of connect with you and check you out more? Because some people, I mean, probably going to
Sure.
call you or email you, so.
Thank you. So if you go to dustyrollins.com, ROLLINS, and we'll probably have a link in the show notes, hopefully. And then that site, I do have a book coming out, self-published, called The Taxpayer Manifesto. And I call it, it's a short little quick read book, because it's not, it's not a tax tomb. And then also on that site, you can get on my email list, or what I even prefer, and most people prefer, I have a print newsletter that I send out.
Okay.
And that's totally free, but is quite valuable. And that they can get on my newsletter list there if they send us their mailing address.
Awesome. Hey, by the way, now can you serve people in other states too, or is it just Florida? Or
thank you. All states, but it's got to be U.S. tax code.
Gotcha. Okay.
I take a month off and go live in Asia where I grew up. I take my family back. And the last time I was there, my wife was saying, well, what about Malaysian taxes? Are you going to, I'm like, no, I'm not learning anymore. Right. I'll just enjoy living there and focus on U.S. taxes. And another guy asked me last thing, he said, well, you're probably against the fair tax, aren't you? I said, hell no. I would love the fair tax, because that would boom our economy like nothing else. Even it would shadow what we're even doing now.
I agree.
And guess what? I think I'm a reasonably decent, smart guy. I'll go find something else to do, if we can kill this tax thing. So I'm for the fair tax, but before we get there, let me help you not overpay on your taxes now.
There you go. Well, listen, I think I speak for a lot of people. That's when I say thanks from the bottom of my heart for taking your precious, valuable time. I know you're a busy, successful guy, and for you to do this, I know it was a big benefit for us, and I appreciate it. I think everybody else does too. If everybody listening, if everybody listening, you just subscribe to the podcast. Just go to whatever channel you're on now if you haven't already, and definitely go to myinvestmentservices.com. This is the kind of stuff we talk about. We obviously talk about directly in real estate investing, but this is all pertinent, relevant, and you need to know this stuff, man, because you're going to make money. You got to know how to keep more of your investment income. So definitely pay attention, check it out, become part of the group. You can check it out for free. And we'll see you on the next podcast next week. In the meantime, God bless you and your families. Take care. Have a wonderful weekend. And Dusty, God bless you too and your family.
Thanks for listening to this episode of Real Estate Investing for Professional Men and Women. Be sure to go to myinvestmentservices.com to join our community and start building wealth today.